Nick, as you look at this slide that we have seen in emerging markets and in emerging market debt, there's been a lot of discussion about how much further it has to go, whether it is perhaps time to step into some of these assets. Where do you stand in that debate?
Well, certainly when you look at emerging markets, we're much closer to the end of that move than the start of it. And for selected emerging markets, the reality is some of those valuations are becoming fairly irresistible as we look forward.
Irresistible. Where in particular is particularly appealing to you at these valuations?
So I think if we start very much at the lower end of the risk spectrum to start with, when you look at a country like Mexico, when you look at a country like Indonesia, again, you've got yields 8-ish% there. When you look at some of the higher risk places, it's all about the political risk. So we'll see that in a month or so in Brazil. We'll also see it still clearly when you look at countries like Turkey. But the reality is, when you look at the break-evens, when you look at the amount those currencies have fallen, we're in now the territory where they represent fairly good value.
So what would you be advising clients to buy then, Nick?
So I think that you firstly dip your toes into that dollar-denominated debt. If you think of that as a package, it's down about 5% over the course of this year. That's a pretty big move. And then for the really brave, you could look at the local emerging markets. As a package, as an index, that's down about 10% year to date. That clearly reflects a lot of dollar strength. And that's about as big, really, as it gets for emerging markets. I think the key is that you go in, though, really in incremental and baby footsteps.